Hello, class. Welcome to the discussion of Chapter 12, the last of our chapters having to do with individual taxes. In the last chapter before we take another exam, goes over some of the things that just didn't fit in other places so far. So kind of a miscellaneous topics type of chapter. So first of all, we're going to talk about NOLs. Typically, your income for the 1 year is entirely within that year. So if you had good year or bad year or whatever, it affects only the 1 year. But there is some provision that if you had a really bad year, that perhaps you could use the loss from 1 year to offset income from a different year. That's what net operating loss indicates. All right, so you can see where that could run into some problems. If people could do that, they would create a loss in 1 year to use another year. So of course there's some specific rules about how this works and what would constitute a net operating loss. Okay, so basically the only way you're going to have an NOL is if you have a business. So if you operate your own sole proprietorship Schedule C, you could have an NOL. If you had a partnership, you could have an NOL. But you're not going to have negative wages or something like that. You're never going to have a net operating loss just because you have very little wage income. You have to have a problem with a business in that there was more expenses than income. All right. So there's lots of personal deductions in the tax law, but they cannot result in an NOL. So just because you have negative taxable income does not mean that it's an NOL. In fact, you have to add back. So you get to the negative taxable income. You do the same formula as you would normally for taxable income, and you get a negative. You go, oh, maybe I have an NOL. Well, you got to add back several things to have an NOL. You have to add these back and still have a negative. Okay. So first of all, capital losses in excess on business capital gains. All right. So if you had $3,000 of capital losses that have nothing to do with business for a minute, then that isn't counted in calculating your net operating loss. You have to add that back. So if that's what caused you to be negative, that's not going to do it. Okay? Can't use last year's NOL or a preceding year. Okay? Otherwise, you're going to count it twice. So it has to be only situation for the current year. And non-business deductions in excess of non-business income. This is your itemized or standard deduction. You don't get to, the standard deduction cannot create an NOL for you. You have to add that back. And add back any that are more than your non-business income. Standard deduction or itemized deductions, either one, whichever you used, you have to add them back. Okay? So there's your definition, standard deduction, and itemized deductions other than casualty losses. Remember, casualty losses can only happen in a federally declared disaster area, so that's pretty rare. And then non-business income is only your investment income. None of your other things count as business income. All right. Once the taxpayer's NOL is calculated, it can be carried forward indefinitely, and NOL carried forward reported on line 21. Okay? All right, class, let's look at an example for how we might do the NOL calculation. This person is filing single. We have wages, 24. We have revenues from our business, expenses from the business, capital gains, capital losses. None of these capital gains or losses have anything to do with the business. They are non-business. Itemized deductions, 14,250, none of which are casualty. So they would have itemized because their itemized deductions were higher than the standard. Okay, so when we take and add and subtract all these up, we get taxable income, okay, of 51,750 negative. So it's a candidate for an NOL. But to calculate the NOL, we have to add certain things back. We have to look and see if it was generated by the business. So to calculate the NOL, there's two ways. The way we talked about in the PowerPoint shows the adding back. So you start with the negative taxable income, add back the itemized deductions, add back the net, because the losses were higher than the gains. So add back this loss of $1,500, which is the net of those two. And if you do that, you get $36,000. The other way to do it is to take the revenues minus the expenses, get the negative 60, and then add the wages. So you go with the business income and the wages only, and you ignore these, okay, because they are not counted, and you get the same result. So there's two ways. You can either start with taxable income negative and keep adding back things that don't belong, or you can add up just the things that have to do with business and as far as add and subtract things that have to do with business. So that's the two ways to do that. All right, one other source of headaches, you might say, in the tax law is what's called the alternative minimum tax. And so this is a parallel tax system, meaning that everybody technically is supposed to calculate their taxes based on the regular tax rates that we've been talking about, as well as the alternative minimum tax, and they actually have to pay the higher of the two. Now, fortunately for most people, the regular tax is higher and this is not going to apply. But there are people that this is going to apply. So this is the rules for the alternative minimum tax. Okay? We start with taxable income before the standard deduction. All right? So the exemption deduction doesn't apply in 2018. We make some adjustments based on different tax rules. Okay, we take out the AMT exemption, we multiply it by the AMT tax rate, and then we compare the regular income tax to the AMT, and we pay the higher one. So the AMT actually becomes the amount by which the tentative minimum tax is higher than the regular income tax. So what adjustments do we need? Recovery of costs, passive losses and tax, and excluded income. There's others, but these are the most common. We got to use a different, if we have a business or a rental property or some other thing like that, we have some different recovery of costs. We have to use different depreciation methods. Notice that it only applies where you didn't take bonus depreciation. So bonus depreciation makes this one happen less often these days, okay, as long as we have bonus depreciation. If there's a difference in depreciation, there's also going to be a difference in passive losses and the amount that's going to be calculated for passive losses. And then there are specific tax-exempt income that is tax exempt for regular income but is not tax exempt for AMT calculations. Some bonds, municipal bonds, remember municipal bonds are tax exempt most of the time, but if they have a specific, what we call private activity, then they could have interest that is included for AMT purposes. Okay, stock options is another one, and we're not going to the difference in the incentive stock options, but also the excluded gain on 1202 stock. Itemized deductions are added back. Taxes are the main one. Okay, Used to be taxes and miscellaneous itemized deductions, but there's miscellaneous gone away for everybody, not just AMT. So there's fewer differences there. And then you subtract the exemption. This keeps most people, out of the AMT. So you get one big exemption instead of multiple. It doesn't matter how many kids or any of those kind of things. It has to do only with your filing status. And this phases out if you get your income higher than this. This for 2018 went up way higher than it was before. This 500,000 a million. So you got to have a lot of income before this starts to phase out. Under the old law, it was a lot lower. So AMTI of 158 after you made all your adjustments. The exemption is still 70 because they don't exceed the threshold. And then you multiply by the tax rate. You have two tax rates for AMT, 26 and 28. First 191,500, and that is 26. Anything after that is 28. All right, and then you compare it to the regular tax. 210 regular tax income is 22,600. Exemption is 109,400. We've already done the adjustments. Did not go over the $1 million, so there's no need to reduce it. We take the rate, we multiply it by 26% because there's only two rates. Minimum tax is 26. That's over the regular tax by 35.56. So that's the amount of AMT. This is all done on Form 6251. Okay, so this is one form where you want to look carefully at the instructions here as to the lines. These are all the adjustments. Here is the exemption amounts down here and the comparison to regular tax, so forth. Now we're going to look at some business credits in part 2. So we'll come back for that.